What's up, everybody? My name is Jeff Layton. I am a real estate agent,
I'm Sean, I'm a lender.
and we're going to be talking about the full requirements for the FHA loan, the super popular FHA loan. I have one of them myself. Sean has done a ton of those. So let's jump into it. Number one, what is the credit score requirement, minimum credit score?
Yeah, a lot of times FHA, you think of like a 620 credit score, but in fact, FHA doesn't require a credit score of a 620. They actually would allow for a 500 credit score. So at 580 or less, it's a 10% down payment. If a credit score is 580 or higher, the down payment is 3.5%. And then bankers can make up higher requirements like a 620 credit score. But a 500 credit score will get it done.
That's pretty good. Most loans you're not allowed to. You got to be in the mid 600s for most loans. And obviously, like Sean said, each lender is going to kind of have like their different requirements. So one lender might be a little more conservative than another, but always reach out to Sean. He can give you some different scenarios. Next up, the minimum down payment is 3.5%, which is great. Only 3.5% down.
Yeah, so in some special situations, like if it's a HUD foreclosure home, they would allow for a lower down payment of just $100. But standard with a 580 or higher credit score, the minimum investment is 3.5%. And you can get those funds. The 3.5% is a gift. You can borrow money from your 401k loan. And that's the minimum investment. You could always put more, and that could improve the financial outlook.
Yeah, so FHA is going to be more flexible with like the gift funds. And if you do have a family member, friend, whoever it is, giving you money for a down payment, or you're getting any type of money, like always document that to the lender, because if like $20,000 just shows up in your account one day, like the lender's going to need to see like where that came from and going to have to kind of like track it a little bit just for the underwriting purposes.
Yeah, and sometimes when people are getting married, you get gifts from like multiple sources or family members. And there's a process to document basically like wedding registry funds or like gifts received in an event of a wedding or special occasion. We use common sense, but we do also have to follow some rules. So it's just best to kind of talk that situation out before you start moving money. Lenders always have to worry about money laundering rules and kind of where money's coming from to make sure we qualify for the investor.
Yeah, always disclose different things to your lender. Next up, we have closing costs. So closing costs for an FHA loan are going to be around 3% typically.
Yeah, so I mean, 3% is kind of this rule that the industry's kind of made up. It's typically based on like the average price, but in our area, Northern Virginia, sometimes we get some types of homes that are like lower purchase prices, like condos, where the closing costs would be higher than the 3%. So lower loan amounts, but you have some flat fixed costs for government, transfer taxes, condo move-in called a capital contribution, and sometimes we need to pre-collect the HOA payments at time of closing so that cash to close can be higher. So the nice thing with the FHA financing is conventional is a 3% max seller contribution, but FHA allows for the seller to contribute 6%. So sometimes it works out best for some of our clients to have a 6% seller credit to help pay for all those closing costs, even if it might exceed that 3% threshold.
And that's, the 6%, that's something your agent, like myself, we would try to negotiate on your behalf. Like 6% is not like standard, but you're allowed up to 6%. So if a property's like been sitting on the market for a while, maybe you offer full price, but then you ask for a 6% seller subsidy, and then, you're allowed to, with FHA, to have 6% go towards closing costs, maybe paying some condo fees and discount points so you can get a lower interest rate, that kind of thing. Next up, we have the types of homes. So what's great about FHA, you can buy literally an apartment building. You can buy a 4-unit apartment building, which is actually what I did when I first got started in real estate. And you can live in 1 unit and then rent out the other 3 units. But you can also do condos. You can do almost any type of property.
Yeah, so pretty much your traditional like move-in ready. In some cases, Jeff, we can do like a 6-unit building, convert it through like a renovation loan, and have a 4-unit. So that 4-unit or 4 doors is the max amount of doors that we can have on 1 unit for FHA financing. And we can go up to $2.2 million in Northern Virginia, which is incredible. But we can do for like home property types, we can do condo like high-rise, we can do condo townhomes, we can do single-family residence, manufactured homes. So a lot of flexibility.
And one thing to keep in mind too, though, every now and then some condo buildings might not be FHA approved, and that's typically if they have a lot of people like not paying their condo dues, or maybe a lot of rental properties in the condo building. So your agent should check and make sure that the building is actually FHA approved, because some are not. And your lender can easily check that information. They have a list, right?
Yeah, absolutely.
Of the different ones. Next up, it must be your primary residence for at least a year. It has to be your intention, because a lot of people, what they want to do is buy like a 4-unit, or because you only have to put 3.5% down, you can quickly turn that into a rental property. But the regulations are you have to live there for at least a year. It has to be your intention, and then you can turn it into a rental property.
Yep. So anytime we're purchasing a home as a primary residence, the lender's always looking at the perspective, like our intent on day one is that we would be there for 12 months. Now, in some situations, life happens. You have twins or triplets, or you need to go take care of a family member, and you may move sooner than that, and that's just part of life happens. But day one, your intent is that 12 months would be your primary residence, and FHA is just for primary residence purchase. You can have more than one FHA loan, but typically in those situations, it would be that we purchased a home using the FHA financing, and then over a period of time, maybe we've moved or upsized. The most common one is, maybe it's a family and they're having children, and so they would buy a bigger home or a better location for work, school, and you can use your FHA loan a second time, so you can have multiple. There's just some requirements there. So we saw a family size increase, and then we can also see a requirement for distance. So like 100 miles from your current home would be a secondary one, that you've moved so far away from your current FHA loan that you could get another. So there's a couple of little nuances there.
And Sean knows the ins and outs of the FHA, because me personally, I don't see a lot of people doing multiple FHA, but most people don't even know that you can do it. So Sean would be a person to talk to about how that could actually be done. Next up, you also have to move into the property within 60 days. So with FHA loans, that's pretty much most loans.
Yeah.
Like you can buy a fixer-upper, maybe not a fixer-upper, it has to be in livable condition, but you do have to move into the property, maybe do some repairs within 60 days. That's just the requirement.
Yeah, and from the lender's perspective, again, where does the 60 days come from? It's just basically enough time for you to kind of transition from one property, like a rental, into your new primary residence. And the reason you want to do 60 days is that we don't want the home abandoned too long in case a pipe breaks or a tree falls. We don't want that that damage to continue to grow and cause more problems. If somebody's living there, they'll usually take care of it quicker. And the exception to that, Jeff mentioned earlier, just renovation loans. So there's an FHA renovation, referred to as a 203K. And on those particular ones, so if we do find like a very distressed, like for my situation, multifamily, like a 4-unit, a rental, maybe it hasn't been framed on the inside, but the FHA loan is the best loan for our client. Mm-hmm. We can do an FHA loan and then basically finance into the loan 6 months of payments. So while you're doing renovation work, you could be living or renting and having 6 months of payments covered by that escrow account. So that's a good strategy. So there's kind of some workarounds.
Yeah, and FHA 203Ks, they take a little bit longer, but maybe like 45 days to close or so.
Yeah, I think that, it's just a more communication. You got an extra party involved, which is typically the general consultant, the GC, and then you also can have a HUD consultant depending on how large of a scope of work that you're working on.
So if you're doing basically like a non-livable property or property that needs a substantial amount of work, a 203K could be a good idea if you're patient and everything like that. The FHA that I purchased, it was nice, it was livable, it could use some updating, but we didn't get another it wasn't FHA 203K where we got another contractor involved or anything like that. Next up, the interest rate compared to conventional loans is pretty good, right?
Yeah, the interest rates on its face value compared to like other programs like a conventional loan, the FHA interest rate is going to be lower.
Yeah, and I was going to also add, it also obviously depends on your credit score, that kind of thing. The better credit score you have, like if you have the 500 credit score, you can still get FHA approved, but it's not going to be as good as the 740 or the.
Yeah. So I mean, I think FHA gives us a lot of flexibility. We were talking about credit scores earlier, like 500, 580, 620. These are some kind of benchmarks for interest rate qualifications too. So the FHA has a lower interest rate, but we always want to compare both scenarios. How many loans does our buyers qualify for, like conventional FHA, maybe VA or USDA? And we want to compare those options because while FHA has a lower rate, it does also carry monthly mortgage insurance, potentially for the life of the loan, unless you're doing a 10% down payment, then it can be removed in like 11 years. And then it also has a cost up front. We call that the upfront mortgage insurance premium. And that can be financed or rolled into it, but that's something that you would pay back on the resale. So we always want to look at an objective approach, not just interest rate, but how does it affect the monthly payment? How does it affect your cash to close or closing costs? And that really makes the best decision for the client.
Yeah, exactly. So like if you're working with someone like myself or an agent, if you're outside of the DC area, I can refer you to an agent. But like someone like myself, we might look at 5, 10, 20 different properties, whether it's online or in person. And then you'll have a great idea of like, you'll choose the best, the cream of the crop, you'll choose the best one. And then you'll talk to Sean and he'll lay out like 3 or 4 different scenarios. So you can get the best property with the best rate to get you the best deal. And real quick, before we go to the next point, if you're looking to buy or sell in the DC area, reach out to us below. Our contact information is there. Or if you're looking nationwide, we can also put you in touch with some great people. Next up, another thing, you can do adjustable as well as fixed rate mortgages. Most people just get fixed rate, I think, with FHA, but you can also do the adjustable rate.
Yeah, so, and you can also get different terms. So, adjustable rate mortgage kind of has a bad rap from like that 2009 time frame where there were a lot more foreclosures, housing bust, that kind of thing. But adjustable rate mortgages are, I think, great, especially if it can help lower interest rates. So adjustable rate mortgage means that it's fixed for a period of time, 5, 7, 10 years, which is really a long time. And if the rate's better than a 30-year fix, that could be a better option for you. But it also depends, like adjustable rate mortgage versus fixed. It also kind of depends on like the treasury bond market, the mortgage-backed security. Sometimes adjustable rate mortgages aren't always cheaper than a 30-year fix. It depends on kind of some other demand features in the market. But like I think it's all about options. When you have options, you feel empowered. You're trying to get information from your friends, your family, the internet, and you really don't know how to make heads or tails of it sometimes, and it can lead to a little bit of a frustration or a bad experience. So Jeff and I's perspective is coming with the idea of bringing a lot of different options, like these are everything that we could do or we could run into, and help educate you. So as we go through this process of buying a home, you're really kind of narrowing it down into which one works best for you based on cash, like your cash flow, that's the monthly payment, and how much money do we have available to purchase a home.
Yeah, one of the biggest mistakes, the first property I ever bought was a studio condo because it was the only thing I could afford. And I just looked at like 2 places. But if I had looked at more options and had more options available, I probably would have made a better decision, because studio condos, they're nice and all, they're cheap, but they don't really appreciate and value too much. Next up, income requirements. So you need a 2-year job history. That's going to, for most loans, that's going to be pretty standard.
Yeah, I just finished a home buyer workshop recently, and we had a situation where somebody was told that they don't qualify for a loan because they don't have a 2-year work history. So just to kind of clarify, we're asking buyers like what they've been doing for the last 2 years. So that could be working, that could also be going to school, it could be taking care of family members. So we just want to document that on the application and make sure that we have stability, that we have work experience, that we have the skills necessary to do the tasks. So with that in mind, sometimes like a student coming out of college, starting day one on their first job, they qualify for an FHA financing loan. And some, like if they've had some time off, maybe they raised children, they have a gap greater than 6 months, maybe they need to be on the workforce a little bit longer, or we need to kind of go a little bit further in the history to show that they do have a lot of work experience. So there's flexibility there. I think a lot of times people put up like a wall and say this is like a limiting belief, I can't buy a home because I haven't been at this job for 2 years. And that's not needed.
Yeah, bottom line, Sean can get creative, and he's pretty experienced. So if you have any questions, if you might, because some people think you need 20% down and need to be working for 10 years and be CEO, or maybe not that extreme, but you'd be surprised. You might be able to actually afford a property. So reach out to Sean anytime, and he can see what's up. Next up, debt to income ratio. So that's pretty important with any loan. I have written down 43%, but you said you can actually go a little bit higher if necessary. Like obviously the goal is not to max you out or anything like that, but if you found the perfect property and it works for you, we can probably make it work.
Yeah, I mean, life kind of throws us all kinds of curveballs, so sometimes when we do like an application to purchase a home, maybe our spouse or a family or a partner, they can't be on the loan because they have lower credit scores, or maybe they might not get the best terms. So the FHA flexibility to go as high as sometimes 55% gross income. So gross income monthly times 55%, that's about the monthly payment that we would qualify you for, which typically for most people is a lot. But even though the number is higher, like 55%, it doesn't mean that the household doesn't have more income. And we see a lot of our clients doing like side hustles, or have some creative content going on. They're doing some moonlighting, all kinds of a variety. Maybe the lender's not looking at as far as income, so you would get a higher income ratio, but they feel comfortable making the payment. So FHA is great to have more flexibility in qualifying for a loan when we don't traditionally can document all of the work source income that we have.
Yeah. Next up, one downside of FHA is great because it's lower credit score, lower down payment, buy an apartment building, but you do have to pay mortgage insurance. So anytime you're putting less than 20% down on a property, you have to pay mortgage insurance. Although with FHA, I think it's basically for the life of the loan, unless you put down 10% originally, and then you'd have to wait 11 years. It's a very specific number, but you're going to pretty much have mortgage insurance for the lifetime of the loan. And
do you know they call this declining mortgage insurance? So as you make payments, so even though it's there for like 11 years or the life of the loan, it's not a flat number like typically what you see on conventional loans.
Okay.
It starts off at a higher number based on the amount of money you owe, principal, and then as you pay over time, that mortgage payment, mortgage insurance premium decreases over time.
And that's just because the less you put down, the higher risk it is for the lender. So they have that mortgage in there to basically cover that. And next up, we have the FHA appraisal. So they basically, any lender really, but they want you to be buying a structurally sound, like livable property when it comes to like a standard FHA property. So the FHA appraisal might be a little bit stricter than a typical appraisal.
Yeah, so let's just talk about appraisals for a second. Like lenders are ordering appraisals through a third-party appraisal management company, and so there's always a third party looking at the property. So what are we comparing this like condition to? Conventional financing is basically just kind of coming through the home. They're making sure health and safety is good, and that's required for all properties. Health and safety is super important. And then for FHA, it's a little bit kind of a little blend of like maybe kind of a home inspection a little bit, because that appraiser is turning on the water. They're making sure the downspouts outside are connected, the toilet flushes, the HVAC kicks on. So they're doing like a little couple of extra things in addition to it. But a lot of times we can just hedge this off. I know you're great about this, Jeff. You were always calling the seller listing agent and saying, hey, what's going on with this home? I did the walkthrough. I saw some peeling paint on the window. Let's scratch that off and repaint that before the appraiser comes out there, because we're experienced. We already know if there's going to be an issue. We can just hedge it off right from the get-go and help that listing agent, if they're not familiar, make sure that we have a great experience. And we don't really have problems with it.
Yeah, no, I had one recently where it was there was like a broken window in the back, and we knew the appraiser was obviously going to flag that, so we just had the seller replace the window before the appraiser went out there, and then everything checked out. And that's also, when I'm making offers with FHA loans, Sean's a local lender. We say, hey, we have a local lender who can close quickly, because the seller's perception of FHA, if there's like multiple offers, they might lean more towards the conventional, because conventional is typically a little bit less strict and can close a little bit faster. So that's why with FHA, you want to have everything going in your favor if there's multiple offers. So that's why like working with local people that can close quickly is important, because listing agents sometimes, if they're looking between different offers and they have an FHA and then conventional, they're probably going to lean more towards the conventional unless there's something weird with that contract.
Yeah, I think we could do a whole video on different strategies at time of offer, like going into the negotiation, all these like little things that we're doing to help strengthen our buyers' representation to make sure that they win deals, even if there's some blight with a listing agent saying, oh, I don't like this, I don't like that. We can typically work through that, and we have some strategies for that.
Yeah, because I'll say things like, hey, I have a handyman. If there's any like small repairs that come up, I can just send them out there easily and quickly. I also have a lot of relationships with agents that helps, as opposed to like if you're just some random agent submitting a property that they've never worked with before, that can be tougher. And then obviously working with a local lender that has 5-star reviews. Next up, we have FHA loan limits. So I think we briefly touched on that, but you can get pretty high. Like for a single, it depends on the city. So if you're in San Francisco, it's going to go super high. Like for single family, 2-unit, 3-unit, 4-unit, it could get up to like $2 million range.
Yeah.
For 3.5% down.
I just kind of round it off. I just say like 2.2 million for a quadplex, which is 4 doors. So you can literally, like, this blows my mind. You can buy a home for $2.2 million with a down payment of 3.5%. That's crazy.
Yeah. And then have three different people. It's in a nice area, so the rent should be pretty high. Presumably paying some or a good amount, or maybe all of your mortgage.
Yeah.
That's pretty cool. And then as far as streamline refinance, so that's usually when you're refinancing a loan, it can be a pretty tedious process. They're going to ask you for tons of documents, credit score, all this stuff. However, FHA has a streamlined process, just like it sounds. It's called a streamlined refinance. And it basically, the requirements are like, do you have a pulse, and will your payment be lower? And then it's a lot easier to actually get a lower rate.
Yeah, I would say, like, we have like seasonality of interest rates, like between like January and December, where like rates kind of go up a little bit in the springtime and fall during the summer months, and then kind of come back up in the fall or the end of the year. So you get some kind of like seasonality. But about every 10 years, we also have kind of a bigger economic flow of interest rates. So we see interest rates kind of crest at the top, and then we kind of see several years where they're starting to decrease over time. So having an FHA loan is great in the sense that with the streamline option, we don't need some of the requirements that we did before, appraisal, strict income requirements. I mean, the idea is that if you can make the payment at a higher rate, you certainly can make the payment at a lower rate. And so if we just basically just take your current balance, restructure a lower interest rate, that's it. I mean, it's that simple. So it's great to catch those ups and downs. And I think, like, life changes. Like, we have clients that sometimes are in a season where they're have left a W-2 position working for an employer, and now they're a business owner, and now they don't qualify because they've only been in business 1 year, even though they're making great income. So a streamlined refinance allows them to capture that lower rate or dip when the time comes, and helps them save some money.
Yeah, and you can always reach out to Sean to say, hey, like, can you just run some numbers, see if this refinance would make sense? And also, before we get to the next point, it's always a good idea. I always tell my buyers, like, get a pre-approval, to start shopping, so you know what your monthly payment would be. You're not, once you get your pre-approval, you're not obligated to like use that exact, specific financing or anything like that. But it's a good starting point. You want to know, can you afford $1 million? Can you only afford 500, 100,000? What's your payment going to be? What's the rate going to be? That kind of thing. So that's usually like the first step in the process, is to reach out to us, get you pre-approved. Then you and I will start like looking at different properties.
Do you know this, Jeff, that 68% of people purchasing a home experience a very bad experience or don't even close on time?
No.
That's like over half.
Wow.
So here's the point to what, Jeff, I think you're making, is that, having a pre-planning conversation and kind of doing some legwork ahead of time, talking about options, loans, renovation, maybe kind of getting some like things in your mind kind of organized, helps cut down on stress. You can do paperwork ahead of time. You have better expectations. And I think looking at like a fee sheet, I call it, like who's involved, what do those prices look like, what's my monthly payment look like, really help kind of frame up this process, which can be really scary sometimes, I think, with first-time home buyers, because they don't know what's going on, Yeah. But I would argue that every time that we purchase a home, it's a little scary.
Yeah.
Because we've got new sellers, we've got a new time, there's new things going on in our life. So I think it's just really great to start down and having a great conversation, Jeff.
Well, that's an interesting point you brought up, because I had a guy recently, very nice guy, and he wanted to use this one lender. And I looked up the lender, and the lender, I'm not even joking, it was 1.5, he was using a VA loan, and it was some type of veteran, they kind of had some type of veteran specialty, it seemed like. But all their reviews were like 1.5 stars. And there was multiple people saying, this is the worst experience I've ever had, like, do not use them. And I was like, look, man, I can't let you use this lender. Look at their reviews. Let's look at like Sean's reviews. Let's compare the two. They're going to be drastically different. So it still amazes me that people don't just having good reviews is like the biggest thing.
Yeah, I think we live in an environment where people can kind of exchange that experience, and I think it's one way to that you can kind of vet somebody.
Yeah, and people, a lot of times people think the house buying process is just like you press a button and then it just like, there's not much to it, but there are actually a lot of moving pieces. So that is why you want to use a well-reviewed agent and lender. I also had another quick story here. This was a lender, I think they were based in California, and it was kind of like one of these online lenders that was super cheap, or at least they advertised they were super cheap. Sometimes they add on fees at the end. And
bait and switch.
Yeah, we were like a week away from closing, or a few days away from closing. We'd been in touch with them, and they had basically like almost forgotten that there was even a closing, and we had to like, there was a lot of phone calls made. It was a very, I think we had to get an extension, but they basically like forgot that there was even a closing like supposed to happen that day. And they had no like response or anything. And I was like, man, this, and I had not, I was like, do not use these people. Use somebody else that's local that can pick up the phone, that you can text, you can call, you can email. It's not some 1-800 number like halfway across the country.
Yeah. Yeah, I mean, I think it's super important. I was just thinking too, when we talk about like contingencies, I think like a whole nother video for it. But when we do an FHA financing, one of the requirements from the lender perspective is that we have to execute the FHA amendatory clause, which basically is an appraisal contingency. So if things don't work out on the appraisal, we can get out of the contract. And like I think you could also negotiate with a financing contingency. So you want these ways out, especially if you have a lender that's not showing up on time. Like what happens in that situation, then you're in default of the contract, you could lose your money. So that's really what this conversation is about, is that when a buyer is putting 1% to 3% down to purchase a home, that's at risk if we're not closing on time, or you don't have a great experience, or maybe in our market, we're competitive, right? Like, I mean, we see a lot of contingencies being waived. And so, you get to that 12th hour, and like the last part of the process, and they don't close on time, you could be looking between $10,000 and $20,000 that you could be out because you didn't perform to the contract. And unfortunately, we hear stories like that.
Yeah. And it's important to have every possible factor going in your favor when you're buying a house, especially for the first time. Like good title company, good lender, good agent, good home inspector. Like we have all of those kind of together, and we've also done it hundreds of times before, so we can kind of see problems ahead of time. It always scares me when it's like a brand new agent or a lender that doesn't have a great reputation, and it's just like, man, you better say a prayer and hope that nothing messes. Sometimes it goes amazing, sometimes not so much. I think we briefly talked about this, but the loan terms, most people do 30 years, but you can also do less than that. This goes back to looking at different options, but you don't have to do 30 years if you don't want to.
Yeah, so it's kind of like, if you don't know, like interest rates change, and there's some volatility to that. And so what that comes from is like investors have requirements, or they look for things for like what they call mortgage-backed securities. So, for some loan officers, they just always go to the same pitch every time, 30-year fixed, 30-year fixed. They don't really show options. I think that's a big problem, honestly. So, when we look at this, we're in kind of this cycle right now where we've been kind of seeing interest rates at a higher, so kind of cresting and kind of changing. When we see these in markets, sometimes we're starting to see like a 20 or a 25-year have lower interest rates than a 30-year. The pro and con to this conversation is that, if you're going to shorten your term from a 30-year term to a 20-year term, you're going to make more payment like per month, because you're going to pay it off in an accelerated time. The idea is that if we can lower the interest rate enough, or we have enough payment like comfort level with that 20-year note, that could be an option too. So I think we don't rule that out. So ARMs, variable terms like 20, 25, 30, 15-year, et cetera. I think those are all kind of just different options, but they based on the goals of our clients. So if they have room, like they have enough income, that could be a good suggestion.
Yeah, and I'm going to throw out a cool little strategy, a little house hacking tip here.
Ooh, I like house hacks.
Yeah, house hacking is all the rage, and it's a great idea. I've done it, and it works. So what you could do is you could buy an FHA, like a 4-unit property with your FHA loan. And if you've looked at 5, 10, 20 of them, you should be getting a pretty good deal. If you're working with myself, you're going to be getting a good deal. And then what you could do after that year is up, and you've lived there for a year, then you could, or maybe it's a year and a half, 2 years, whatever it may be, you could refinance that into a conventional, because you need about 20% equity, depending on the type of loan and that kind of thing. And then you could use that FHA loan again. Now there are, like Sean was saying, there are some scenarios where you can use the FHA more than once, but this, you would use the FHA originally, convert it back into a conventional loan, then you can buy another 4-unit, and then within like 3 or 4 years, if you wanted to get all crazy with it, like you could have use this FHA loan 3, 4, or 5 times and have a pretty massive portfolio there, and really set you up pretty good for the future.
That's right. Yeah, so thinking about this, like this would be a situation like if I lived in a 4-unit building, that means my space is probably a little bit smaller. So if I were to like buy an FHA 4-unit property and then go buy, say, a single family home, for my family and I, because now I have kids, and you know, a backyard and all that stuff, we can do an FHA. That one totally makes sense because we're going from like a small living space. We've been there for a period of time. We have increased family size. We're getting a bigger house for the family. FHA works for that too. You know, like we're in an environment right now where we're starting to see interest rates kind of hit the ceiling and kind of start decreasing. So, you know, from my perspective, refinancing only makes sense if it puts us in a better financial position, not always just for the loan scenario. Refinancing costs money. I mean, there's attorneys and titles and sometimes appraisers involved in these situations. So, you know, we would advise you based on what we financially, like personally, like Jeff and I would do if it was our own money, if it was our own house, our own situation.
Yeah, and so how to apply for an FHA loan? Reach out to Sean and myself below. Like I said, we're in the DC area, so we'd love to assist you if you're looking at Washington, DC, Northern Virginia, Maryland. We can definitely assist you. Or if you're nationwide, we can also put you in touch with some great people. So see you on the next one.
See ya.